Good evening. We'd like to welcome you tonight to our special event with presenter Robert Kuttner, Squandering America, How Politics Undermines Prosperity. We appreciate you coming tonight to this kickoff event for the Wisconsin Institute for Public Policy and Service and UW-Marathon County's series on wealth and poverty in America, Bridging the Divide. The Institute seeks to enhance the civic life of communities throughout Wisconsin with educational outreach, internships, and service learning opportunities, public scholarship, nonpartisan public dialogue, and dissemination of ideas generated through research and programming. The 2008-2009 theme, Wealth and Poverty in America, Bridging the Divide, is designed to help communities address the increasing disparity between the haves and have-nots in our society. And our series of events, beginning with this one, reflects an effort to study, present research, discuss, and learn together about the causes and consequences of poverty in America and in our communities here in Wisconsin. So I'd like to announce a few additional events, some upcoming events. First of all, on November 5th, we'll have a panel entitled Globalization, the Market Economy and Its Impact on Wisconsin. That will be here in the UWMC Theater, so we welcome you to that event. We're also continuing our ongoing dialogues on crime and punishment in Marathon County, and we'll be holding these deliberations in various Marathon County branch libraries, including October 13th at the Wausau Area Hmong Mutual Association, October 20th in Athens, October 21st here at the UWC-MC campus, and October 27th in Spencer. And finally, November 10, we'll have another crime and punishment dialogue at the main library in Wausau. If you'd like some more information, or if you would like to receive a series brochure, which I think we have available through Program Associate Gene Greenwood, please see Gene or myself after the program. The Wisconsin Institute would like to acknowledge the generous support of the University of Wisconsin-Marathon County, the UW Colleges and UW Extension, the Wisconsin Humanities Council, Marathon County, the Marathon County Public Library, the National Endowment for the Humanities, the Alexander Foundation, the B.A. and Esther Greenheck Foundation, the Kettering Foundation and National Issues Forum, and the Community Foundation of North Central Wisconsin, and finally the UWMC Foundation for all of their support for this programming that we're able to provide. It's my pleasure now to introduce Mark Brown, Professor of Philosophy here at UW-Marathon County, who will introduce our speaker. Mark Brown has been teaching at Marathon County for many years, and most recently was a research fellow for the Wisconsin Institute, in which he put on a wonderful conference on the ethics of stem cell research. He's currently on sabbatical, and so I'd like to welcome Mark Brown. Thank you, Mark.
Good evening. We are exceptionally fortunate tonight to have Robert Kuttner with us in central Wisconsin to address issues of social policy, economic policy, social justice, which have been very much on our minds as current events in New York City and in Washington have riveted our attention. Robert Kuttner is the co-founder and co-editor of the American Prospect magazine and has a syndicated column with the Boston Globe, which is distributed in newspapers across the country. He also is the senior fellow of Demos, a nonpartisan work think tank, which conducts policy analyses for the distribution of policymakers in the district. Robert Kuttner, for decades, has been one of the most influential figures in the formulation of public policy in Washington, D.C. He's the author of numerous books and a variety of, contributes to a variety of what you might call mainstream and academic, elite academic journals, including the New York Times Book Review, Harper's, Atlantic, the New Republic, Business Week, as well as top flight journals such as the New England Journal of Medicine, Connecticut Law Review, and has published a whole series of books. In fact, he's got 2 new books coming, in addition to the one that he's going to talk to us about tonight, Squandering America, about our economic future, and about our recent economic past. Robert Kuttner has a book forthcoming entitled Globalization and the Good Society, and another book forthcoming entitled Obama's Challenge, both of which I suspect are works in progress which will develop as events unfold. He was educated here in the central part of the country at Oberlin College. He is in residence now in Boston and in Washington, D.C. Will you please join me in welcoming our distinguished guest, Robert Kuttner.
Well, thank you so much. It's a pleasure to be in Wisconsin. I spent 3 years as a Senate investigator for William Proxmire, one of the great people to serve in the United States Senate when he was chairman of the Banking Committee, and that's really where I learned my practical economics. My subject this evening is what killed the kind of prosperous, equal era that we enjoyed for 30 years after World War II, and how might we get it back? And how does the financial crisis now unfolding play into this larger drama of who gets what out of the economy? It's interesting. There was a period for more than a quarter of a century after World War II when the economy not only grew at a rapid rate, but it actually became more equal. The bottom 20% gained more income than the top 20%. There's an economist named Claudia Golden who referred to these 25 or 30 years as the Great Compression, a pun on the Great Depression. It was a period when the society became more equal and more secure. What happened? What were the roots of that broadly shared prosperity? And have global circumstances changed so much that we can never get it back? Or is that more a function of our politics than of changed economic realities? It's also interesting that throughout the democratic West, the industrial West, every country experienced something of the same phenomenon. Societies became more equal. In Western Europe, growth rates were even higher than they were in the United States, and unemployment rates were even lower, and societies were more egalitarian. The French refer to the 30 years after the war as les 30 glorieuses, the 30 glorious years, a kind of a golden age of managed capitalism. And beginning in the late 1970s, economists started noticing what ordinary people noticed, that not only was the rate of economic growth slowing down, but more of the gains were going to the top, and the bottom was hurting, and the middle was being squeezed. And there was a tremendous debate among economists about why what a colleague of mine called the Great U-turn had occurred. And I weighed in on this debate in an article that I wrote for the Atlantic Monthly in 1983 called The Declining Middle. What was happening to the great American middle class? Now, this is already 25 years ago, and these trends have only intensified in the quarter century since then. What was causing this? And most economists identified 3 primary factors. One was the fact that the 70s had been a pretty dismal decade the oil shocks, the inflation, the stagnation, the high unemployment. And economists said, well, look, when you have a period of high unemployment, it is understandable that income inequality is going to worsen, because if you have unemployment, labor has less bargaining power to bargain for higher wages, and the income distribution is going to widen, and this is simply a temporary legacy of the bad years of the 70s. Then other people said, well, no, it's actually demographic. What happened in the 70s? A lot of baby boomers entered the workforce for the first time. A lot of women entered the workforce for the first time. And if you follow standard economics, the theory is that if you're new and lower skilled and don't have the experience, you're going to get less pay. And so that's why the income distribution supposedly worsened. Then another theory was that this had to do with a sudden uptick in the demand for skills, that because of the new technologies, there was a premium being paid for more highly skilled workers, and that explained the increased inequality. And there was one more theory, that we were witnessing the side effects of a shift from manufacturing to services, that in the manufacturing economy, there were a lot of pretty good jobs that didn't require exceptionally high skills, but that paid a middle-class standard of living. And as the economy shifted from manufacturing into services, a service economy, you know, has fast food workers at one extreme and rocket scientists at the other extreme. So it's only natural that you would have a wider distribution of earnings. Well, I had a different view. My research convinced me that the main reason for the society becoming more unequal was political. That after World War II, after the legacy of the Great Depression, there was a whole series of what you might call equalizing institutions, political inventions, public policy inventions, and a shift in political power from people of great wealth to ordinary people, what John Kenneth Galbraith called countervailing institutions that made for a more equal distribution of society's benefits. And that, yeah, the shift from a manufacturing economy to a service economy had something to do with it. And the fact that there were a lot of baby boomers in the economy for a while, that had something to do with it. And, but the big reason was not economic at all, it was political. Now let's as they say, unpack this. And let's start out with the crash of 1929. Crash of 1929 transformed the relationship of the economy to the government and vice versa. It disgraced, for about 80 years, the idea that financial markets were best left to their own devices, that they could regulate themselves. Almost nobody in the 1930s could argue with a straight face what has become the conventional wisdom of the 1980s and 1990s, that just went crashing down along with Wall Street. It was an ideological crash for the second time, then accompanied a financial crash, the idea that markets can regulate themselves, that market forces don't need government. That was completely discredited by events in 1929 and the Great Depression that followed. And the Roosevelt administration, through the New Deal, transformed politics. Government, which was held in low repute in the boom years of the 1920s, suddenly had a lot of prestige. It put a lot of people back to work. It pulled the economy out of the Great Depression. And through the Roosevelt administration and the New Deal, we went from a largely unregulated form of capitalism to a much more highly regulated form. One of the effects of that was to have a more equal distribution of opportunity and security and earnings. This was the era when the industrial labor movement gained a foothold. It was the era when we invented modern social insurance like Social Security. It was the era when we got serious about regulating finance. And then, due to one of those historical accidents, the Depression was followed by World War II. And World War II completed the job of pulling America out of the Great Depression. In 1939, on the eve of the mobilization for war, the unemployment rate was still about 13%. It had peaked at 25% at the absolute pit of the Great Depression in 1933, but even with all the public works and all the deficit spending that Roosevelt did, we were still mired in a pretty weak economy as late as 1939. And then we mobilized for war. And in the space of a year, the unemployment rate dropped from 13% to 2%. There were suddenly labor shortages. Women who had not been understood to be fit for factory work suddenly worked on assembly lines. African Americans who had been discriminated against were suddenly welcomed into well-paying jobs because the society had totally mobilized for war. We had 12 million men and women in uniform. We needed every worker we could possibly get. All kinds of social advances came along in the wake of the preparation for war. There were daycare centers for the first time at factories so that women with young children could be part of the wartime mobilization. And the output of the economy increased by about 50% during the war, even though about half of what was being produced only so it could be blown up. And as a consequence of the prestige of government during the New Deal and the prestige of government during the war, the fact that this was seen as a great victory, not just for the armed forces, but for the ability of a democracy to organize itself for war, there was a political transformation. Normally, a democracy that is also a market economy has a tension between the first principle of the market, which is $1, one vote, and the first principle of a democracy, which is one citizen, one vote. But because of the prestige of government, the popular support for government, and the disgrace of financial elites, the political power of concentrated wealth was not what it ordinarily had been. And in this period, you had a variety of equalizing institutions. You had strong labor regulation, wages and hours and working conditions. You had the creation of a kind of normalized job, a tacit social compact between the worker and the employer, where if you did your job well, you could expect to work for the same employer for your whole career. You could expect health insurance as a fringe benefit. You could expect a decent pension plan as a benefit. The employer did not pick up and move to Bangladesh. It was also a period of strong trade unions, which were a force not just for better wages for their members, but a force for a more equal distribution of income across the board. It was an era when there was a lot of public works spending, and much of the public works spending, basic things like highways and more exotic things like support for science and technology, were disguised as something that you had to do because of the Cold War. The interstate highway system, beginning in the 1950s, was underwritten by a piece of legislation called the National Defense Highway Act. The conceit was that we needed to run tanks along these highways, and civilians might as well use them too. I had a fellowship at one point in my academic career to study a very exotic language, Spanish, under the National Defense Language Act. And in the 50s and 60s, if you could come up with a defense rationalization for it, you could spend money on all kinds of neat stuff, like computers and basic scientific research. And so this was a period when government was an effective counterweight to the market. And trade unionism was strong, and public investment was strong. It was also a period when a lot of industries were regulated, and they were regulated to prevent the kinds of abuses that had existed in the 20s. They were regulated to protect consumers, but one of the side effects was that they also protected wages, and I'll give you an example. Take electric utilities. In the regime that ended with deregulation in the late 1970s, power companies were either publicly owned or they were privately owned regulated monopolies. And the utility was guaranteed a normal profit, and its business strategy was to invest in technology, try and reduce its costs, increase its customer base, but its business strategy did not include battering down wages, because the wages were part of its rate base, and its profits were based on its rate base plus a reasonable rate of earnings. So public utilities typically had very good labor relations. They had strong unions. They got along with the unions. And this was a good blue-collar job. And you can tell the same story about all of the other regulated industries, such as airlines and telephone companies and trucking and hospitals and several others, which were all deregulated when deregulation came into fashion in the 1970s. So we had a system of capitalism that had a pretty good balance between the power of private wealth and the claims of ordinary people. And the result of this was that ordinary people had a fairly high degree of economic security and opportunity, and the distribution of income was such that we had a very broad-based middle class. So what happened? Well, several things happened to demolish this model a little bit at a time. First of all, by the 1970s, the political power of organized business was enjoying something of a resurgence. Free market economics, which had been disgraced in the 1930s, were also enjoying something of a resurgence. And because of the bad economic performance of the 1970s, primarily the result of the two oil shocks, a lot of the travail of the 70s got blamed on regulation, got blamed on big government. Inflation, which was really set off by the oil shock, was blamed on regulation. And so political conservatives got another turn at running the show. And this really didn't start with Reagan. It started with Carter, who was the most free market Democrat since Grover Cleveland. And the whole dismantling of the Roosevelt system really began in the 70s, and then, of course, it took off like a rocket under Reagan. Another thing that happened, the Vietnam War really blew apart the New Deal coalition as a matter of politics, and the Civil Rights Movement split the old New Deal coalition as a matter of politics, so that the constituency politically that had supported this coalition and the policies that went along with it got into trouble in the 1970s. And then by the 80s, you have the Reagan Revolution, where the process of dismantling equalizing institutions intensifies. And there follows a 30-year period in which ordinary people are becoming less secure economically. Globalization adds to this. It becomes easier to outsource jobs. It becomes easier for companies to decide that they don't like being part of a system where they are regulated or they are taxed. They will just move to locations with lower wages, lower taxes, lower regulations, and that puts pressure on the United States to emulate the countries that don't do as well by their workers, lest more companies move overseas. So the whole thing accelerates in the 80s, and this further weakens the coalition, the political coalition that supports this brand of capitalism. Because if you're not getting much back from the government, you say to yourself, well, if nothing else, I'll vote for the guy who's going to lower my taxes. And we enter into a period of passivity, of cynicism, of a sense that there's really not much the government is going to do for me. And you contrast that with the way the world looked to someone in 1948 in terms of their view of what can be expected from government. Contrast someone who comes of age in, say, 1988 with someone who comes of age in 1948. 1948, the typical young man, and in those years before women were recognized as full economic citizens, we really are talking about male heads of households, as the Census Department calls them. And what did this young man get from government? Well, he was probably a veteran, so he probably benefited from the GI Bill. He may well have gone to college on the GI Bill. He may well have been the first member of his family to go to college. He may well have been the first member of his family to own his own home with a VA mortgage or an FHA mortgage. And the first generation that grew up having Social Security and the likelihood of being a member of a union and strong unemployment insurance if you lost your job. So the person in that era had a much more benign view of government because government reciprocated. The tax code also looked very, very different in 1948 than it did in 1988. Taxes on ordinary working people were very low because we still had a progressive tax code with a top rate of 91%. Payroll taxes were very low, and payroll taxes are the most regressive taxes we have because you pay them on the first dollar of income, and there are no deductibles, no exemptions, and they're actually capped so that a rich person pays a lower rate of payroll tax than an ordinary middle-class person or working-class person. So the bargain that the average citizen in 1948 felt that he or she got back from government was a much better deal than it looked to be 40 years later. And interestingly, very similar trends affected Western Europe for much the same reasons. Even though Europe has a more advanced welfare state, more comprehensive social insurance than we do, at just about the same time in the late 1970s, Europe also falls on hard times. Economic growth slows down. The distribution of income becomes more unequal, although at a much less rapid rate than in the United States for the same kinds of reasons. Now, I want to, before talking about what we face in the current crisis, I want to take you back again to 1929 through a different lens. I want to look at 1929 as a financial crisis because the similarities between what happened in 1929 and what happened in 2007, 2008 are really chilling. If you look at the causes of the great crash of 1929 and the depression that followed, there were all kinds of exotic financial scams, but they really boiled down to three kinds of abuses. First of all, there was much too much speculation with borrowed money. Secondly, there were financial instruments that nobody really understood, not even the people who created them. And thirdly, there were conflicts of interest. People who were financial insiders who made money by deceiving the people that they sold these instruments to. And if that sounds familiar, it's because these are exactly the same abuses that have proliferated once again in the 1990s and in the current decade. Well, why did that happen? Why did we ignore the lessons that we learned in the 1930s? Because in the 30s, one of the tasks of the New Deal was to dig the country out of the Depression, restore purchasing power, put people back to work, devise social insurance. But the other task was to recapitalize and regulate the financial system in the hope that the crash of 1929 would never happen again. And so we got federal deposit insurance, we got much tighter bank regulation, we got the separation of investment banking from commercial banking so that you couldn't create bogus securities and then sell them off to your retail customers using the deposit base of a commercial bank. And the Roosevelt administration pretty well covered all categories of financial institution that existed in the 1930s. Well, what happened? Why did that not stick to the wall? Why are we having to go through this a second time? And the answer is that during the same period, as a result of the same political forces that undermined all of the so-called equalizing institutions, we had a parallel process of financial deregulation beginning in the late 1970s. And we had regulators tolerating the creation of new exotic kinds of financial securities that were essentially unregulated. Because the ideology of the 80s and the 90s, because the Clinton administration was as implicated in this in many ways as the Reagan administration, because the ideology of that era was let financial markets rip, whatever they innovate is by definition good, or the market wouldn't come up with it, regulators just stopped keeping up with a lot of financial scams. And subprime is a perfect case in point, because it was subprime beginning in the summer of 2007 that really triggered this this whole episode that is now ending in a serious financial crash. And I want to go into this in a little bit of detail. Let me add before I do that for about 15 years, as the incomes of ordinary people have stagnated, people have been substituting debt for income. And we've had a series of interconnected bubbles, one of which was the stock market in the 1990s, another of which was the housing bubble. And so the way it worked was your wages were not going up as fast as inflation. You couldn't keep up with the cost of living. But for some reason that you didn't quite comprehend, the value of your house kept going up. So you could take out home equity loans against your house and more or less keep up your standard of living. And this worked only as long as housing prices inflated faster than the real economy. When that went into reverse, people found themselves owing more on their house than the value of their house. And according to this morning's Wall Street Journal, 1 house in 6 today has a mortgage on it that is worth more than the value of the house. Meanwhile, the United States of America has gone into debt to the Chinese and the Saudis and the Japanese. So it isn't just households who find themselves behind the 8 ball, it's the entire economy. And Alan Greenspan, the former head of the Federal Reserve, who was hailed as a kind of genius, I think is one of the real culprits of the piece, because after all of these speculative bubbles started bursting in the 90s, Greenspan's response was to lower interest rates to keep the party going. And by lowering interest rates, he only fed the housing bubble. Because if you could get a very cheap mortgage, that bid up the value of the house. So the stage was set for the abuse that lit the spark that blew up the whole game, namely subprime. And let me take a minute and say a few words about subprime. So let's say that you are a Wall Street company and you're working with a local storefront unregulated mortgage company, a mortgage broker. And you make your money by creating bonds that are backed by mortgages. And this has been going on for about 30 years. It's not new. A government agency, the Federal National Mortgage Association, later known as Fannie Mae, was actually invented during the New Deal in order to replenish the capital of banks. And Fannie Mae would use the government's own borrowing rate and buy mortgages from banks so that banks could have more money to make new mortgages. It worked perfectly. In 1969, Fannie Mae was privatized. And by the 90s, the same kind of wise guys who were playing other kinds of games with other intermediary institutions got control of Fannie Mae. Fannie Mae actually has been blamed for the subprime crisis a lot more than it deserves, because Fannie Mae was the one big player that did not buy subprime mortgages, but I'm getting a little bit ahead of the story. So let me take you back to the Wall Street investment bank that packages these mortgages and the local storefront mortgage broker that originates them. Now, the way you maximize your fees, either as the storefront mortgage company or as the Wall Street firm, is to underwrite higher risk mortgages. That way you can charge higher interest rates for them. So subprime mortgages were invented as a way of extracting higher interest rates, which, when you think about it, is completely perverse, because if somebody doesn't quite have the credit history or the income to take out an ordinary mortgage, the worst thing you can possibly do to that person is charge them a higher interest rate. But the people who invented this figured that only a certain percentage of these mortgages are going to go bust, and if we can charge really exorbitant rates on them, and the rest of them somehow don't go bust because the housing prices are just going to keep inflating through the stratosphere, we'll all get rich. And so the game became a game of how can we charge the most possible interest on a mortgage that we give to somebody who really isn't qualified for it, but we hope the whole thing will work out because the value of the house is increasing. And one of the things that my former boss did, that I'm sure he went to heaven for, was a law passed in the early 70s called the Truth in Lending Act. If you go into a bank and it says the true interest rate is 5.5%, and it is, you can thank Senator Proxmire for that. But I'm sure the good senator is whirling in his grave, because the people who invented subprime found all kinds of ways around the Truth in Lending Act so that people signed up for mortgages that were completely opaque. They didn't really understand what they were signing. And the deal would be you would have a mortgage that was very low, the interest rate was very low, the payment was very low for the first couple of years, and then it would reset. And it would go from 4% to 8% to 12%, maybe even to 16%. And you would say to yourself, well, okay, if it does that, I'll just refinance it. But unbeknownst to you, there would be a huge prepayment penalty where you would have to pay an astronomical amount of money to refinance the mortgage, because in order for this whole thing to work for the companies that packaged it and the companies that ultimately bought the bonds, you had to be locked in. Well, not surprisingly, after a while, a lot of these mortgages went bust. And in 2004, 2005, 2006, they became more reckless, more exotic. There was a category of mortgage known in the industry as a ninja loan, which stood for no income, no job, no asset. And I mean, I'm not kidding. I'm not making this up. And you probably still see these ads on the internet or on television. And you could go into this storefront mortgage company and they would say, we don't want to know your credit history. We don't want to know your income. Just sign here. All they wanted to know was the appraised value of the house. Well, it took about 3 years for this thing to blow up, and when it blew up, it blew sky high. And it gets a lot worse because you've probably heard of something called a derivative. It's one of these terms that gets thrown around that most people don't understand. It's really very simple. A derivative is a financial security that is built on top of a real commodity. So if you have a mortgage which is an actual loan backed by an actual asset. And then you turn that mortgage into a bond. The bond is a derivative. But now you have derivatives on top of derivatives on top of derivatives. It's a giant pyramid scheme. So not only do you have bonds backed by subprime mortgages, which seem to have a value of X, but if the underlying mortgage is junk, the value is not what it's cracked up to be. Then you have a whole other layer of company that insures these bonds against default. And those securities are derivatives on top of derivatives. And you may have noticed the other week that the world's largest insurance company went bust, and the Fed and the Treasury bailed it out to the tune of $85 billion. This was a company called AIG. The reason AIG went bust is because one little unit in London with about 200 people was making profits of billions of dollars a year, writing these insurance contracts against these bonds going bad. And the theory was, well, everybody knows mortgages don't go into default very much, and therefore the bonds that are backed by these mortgages, they probably won't go into default very much either. So we can make a ton of money by selling insurance against the possibility of these bonds going bad. Well, guess what? They all went bad. And so this one little unit in London that thought it was very clever took down the world's biggest insurance company. And the value of all of the contracts that have been written, the derivative contracts, as insurance against other securities going bad, you're not going to believe this, $62 trillion. So what you have is leverage on stilts. You have pyramids on top of pyramids on top of pyramids. And what's going on now is a kind of unwinding, where if the whole pyramid is built on a very small base, and the small base turns out to be rotten, the whole thing unwinds and everybody loses their shirts. This is the fruit of deregulation. And I'll give you two examples. In 1994, when Congress was still controlled by the Democrats, and they noticed that there were some abusive mortgage products being created, they passed a law called the Home Ownership Equity Protection Act. And it said that companies that originate mortgages, even if they're not banks, even if they're just brokers, even if they're not otherwise federally regulated, they have to use prudent underwriting standards. And Alan Greenspan, in his wisdom, refused to issue regulations to implement the law. Now, in 1995, the Republicans took over Congress. They shared Greenspan's philosophy that you didn't need financial regulation, and if Wall Street invented it, it must be a good thing. So it was not until December of 2007 that the Fed deigned to issue regulations, and by then it was too late. In the year 2000, Phil Gramm, John McCain's financial advisor, slipped a law as part of another law, got it through Congress as a favor to a little company called Enron, making it illegal for the federal government to try to regulate these insurance policies on bonds at risk of going bad, so-called credit default swaps. Now, if those two regulatory decisions had gone the other way, if Greenspan had carried out the 1994 legislation regulating subprime, and if Gramm had not sneaked this bill into Congress so that these pyramid schemes of the sort that took down AIG would not have been allowed to proliferate into the stratosphere, you never would have had this crisis. Some people call Iraq a war of choice. This is a crisis of choice. It did not have to be. And I think what has crashed along with the market is the ideology of deregulation. And it's basically the same ideology that free markets can do no wrong, that you don't have to have countervailing institutions, that is the cause of more than 30 years of widening insecurity and widening inequality. Something else happened during these 30 years. It hit younger people with particular force. A political scientist named Jacob Hacker has written a wonderful book about this called The Great Risk Shift. Risks that used to be borne by large institutions such as the government or large corporations have been shifted onto individuals and families. The shift from traditional pensions into 401k plans is a classic example. It used to be that your pension was guaranteed no matter what happened to the stock market, but only about 20% of the workforce has these traditional pensions anymore, and almost no younger workers have them. And so now you have a 401k, and if the market crashes, you crash along with the market. Health insurance used to be provided by good employers. Now, more of the costs are being shifted to individuals. More employers, especially employers of young people, especially employers in the service economy, either don't provide health insurance at all, or they provide it in such a way that most of the premium costs are borne by individuals, and individuals can't afford the premiums, or the out-of-pocket payments are so high that the insurance doesn't do you much good. Half of the people in America who declare medical bankruptcy because of medical expenses have health insurance. So two enormous risks of destitution in old age and lack of health insurance have been shifted from institutions onto individuals. The costs of getting a college education have increased astronomically, even in public institutions, as state legislatures have balanced budgets by cutting back subsidies of community colleges, state universities, other public facilities and institutions, so that today it costs as much to attend a public university as it did to attend a private university only 20 years ago. And the mass entry of women with children into the workforce and the failure of the society to acknowledge that by providing decent child care or decent pre-kindergarten has put those risks onto the family rather than acknowledging that there's been a social revolution. Now, there's one piece of good news, and that is that when you have the kind of crisis that we are experiencing this week and this month and next year on Wall Street, it creates extraordinary possibilities, as was the case in the 1930s. I mean, 6 months ago, Congress was arguing about whether we could afford $100 million for this social program or $200 million for that social program. Last week, they just passed a $1 trillion bailout because they were afraid of a financial crash turning into a Great Depression. And the voters did not like it. You will recall that it failed on the first attempt because Republican congressmen, in a year that's going to be a difficult year for Republicans, were hearing from their constituents by margins of 50 to 1 or 100 to 1, how come Wall Street is getting bailed out when it's Main Street that is suffering? So an opportunity has been created to restore a more balanced economy, a more regulated economy, an economy that serves Main Street, as well as serving Wall Street. And I want to close by telling the story of these two books, which I hope you'll buy. A year and a half ago, I wrote a book called The Squandering of America, predicting that because of deregulation, we were setting ourselves up for a disastrous crash. And the book came out in October of 2007, and I started thinking to myself that the president who takes office in January 2009 is very likely to face a situation similar to what Roosevelt faced. A financial crash, the risk of a crash turning into a general depression, and the opportunity to do great things on behalf of ordinary people. And then I started looking at the field of candidates. And I looked at Edwards and Hillary Clinton and Barack Obama on the Democratic side. I will admit to being a Democrat, so I didn't look terribly hard at the Republican side. And if you were scoring the positions of the three front-running Democrats in the fall of 2007, you would typically say, well, Edwards is kind of the most progressive on pocketbook issues, and Hillary is kind of in between, and Obama is the most middle of the road. And yet, it seemed to me there was something very special about Obama, that of the three of them, he seemed to me, because of his history and because of his character, to be the one who perhaps could rise to real greatness. And I went back and started reading about presidents who had taken power at moments of great crisis and how they had used these crises to transform what was deemed politically possible. Lincoln and Franklin Roosevelt and the Lyndon Johnson of the Civil Rights era. And in each case, these presidents moved public opinion and moved themselves and moved Congress to enact programs and policies that had been deemed unthinkable when they first took office. Lincoln, when he took office, was worrying about keeping the Union together. Freeing the slaves was at the radical fringe of polite debate. And he had almost as much trouble holding together the coalition in the North as he did in holding together the entire Union. When Franklin Roosevelt ran for president, he was in favor of a balanced budget. He was against federal deposit insurance. He was against large-scale public works. And it was only after he took office that he realized that he had to be a much more radical president. Lyndon Johnson took office after Kennedy was assassinated, and the Civil Rights Act had been bottled up in committee by Dixiecrat, racist Southern Committee chairman. But when Johnson succeeded in enacting the Civil Rights Act of 1964, it was the same Congress that had been elected in November of 1962 that had stymied Kennedy. But something about Johnson's commitment to making civil rights his legacy, and the fact that he energized the civil rights movement on the ground enabled him to do what Kennedy had not been able to do. And in each of these cases, there was a social movement. There was the abolitionist movement under Lincoln. There was the industrial labor movement in the 1930s during the Roosevelt era, and the civil rights movement of the 1960s that made it possible for these leaders to rise to greatness and be transformative. And so I said to myself, I'm a magazine editor for my day job, I need to get a great historian to write an article about transformative presidents and moments of crisis. So I called Doris Goodwin, who I enormously admire, and I asked her if she'd write an article. She said, no, I'm working on my next book. I'm too busy, but if you come to my house with a tape recorder, we can have a conversation, and maybe you can write an article about this. So we did, and we published it in the January 2008 issue of the American Prospect as a kind of a question and answer dialogue. And then I called Doris back, and I said, you really have to write a book about this. This is going to be one of those moments when the next president will either be Roosevelt or it will fall in on him and he will be Hoover. And she said, no, you write it, and I'll suggest some sources. I'll read some chapters for you. And so I did. And it's dedicated to Doris Goodwin. And the book is called Obama's Challenge. I took the risk of assuming that Obama would be the next president. And the subtitle is America's Economic Crisis and the Power of a Transformative Presidency. Now, that doesn't mean that rescuing Wall Street and rescuing the financial system in a more effective way than the Paulson Plan does will be easy. But I think if you're talking about $1 trillion for Wall Street, you can also talk about $1 trillion for Main Street. And if the spillover effects of the financial crash continue to proliferate, you're going to need a lot more federal spending. And one of the effects of that federal spending can be to restore a more equal and secure economy. You are about to live through one of the most interesting periods of American history. And you know the old curse, may you live in interesting times. This is going to be one of them. And the question of whether the next president of the United States rises to the moment and turns a crisis into an opportunity, or whether the wave crashes in on him is the great question that awaits the next administration and profoundly will affect all of us. So this is a very opportune moment to have this conversation, and I'm delighted to be with you and more than happy to engage in a dialogue. Thank you so much. I think we have about 45 minutes for questions, or as long as you have the patience to stay and my voice doesn't give out. Yes, sir.
I'm an independent, and I really respect you for some declaration of the Democrats. Firstly, I think both political parties are involved in this mess up to their eyeballs. And one thing about Obama that I question is he seems to be so sure he understands what caused this crisis, and that it's a relatively straightforward solution to it. And my feeling, I've got an undergraduate degree in economics from UW-Madison, and my feeling is that nobody really fully understands this situation right now and really has the full solution for it. For one thing, the AIG, I heard on the radio, they were just given another $35 billion today. Won't it be that when the president assumes office that maybe they'll have to do something really different from what we're doing so far, because it doesn't seem to be working yet?
Well, I agree with you. I mean, I'm pretty confident that I know what caused this. I don't think anybody knows definitively how to cure it. What caused it was deregulation. What caused it was the government's willingness to let Wall Street turn into Las Vegas. And we should have known from what happened in 1929 that that's not a good way to proceed. But diagnosing why it happened and knowing how to fix it are two very different things. And I like Obama better for a variety of reasons, but one of them is that I think that the ideology of deregulation is more characteristically Republican ideology than it is Democratic ideology, and the Democrats are more likely to be willing to use government to re-regulate and recapitalize financial institutions. What does one do going forward? All I can do is give you my opinion. I think the Paulson plan was not a good way to go. Paulson used to be the head of Goldman Sachs, and when he became Treasury Secretary, he continued to think as if he were still the president of Goldman Sachs, and so the philosophy became, how do I bail out my buddies on Wall Street who made bad bets? And so he comes before Congress with a request for $700 billion of bailout money to buy bonds backed by bad mortgages that nobody else wants to buy. This is not a great use of $700 billion of taxpayer money. What would be a good use of $700 billion of taxpayer money? Well, if I were, what is the Dr. Seuss book, If I Ran the Zoo? If I were running the zoo, I would start with the other end of the telescope. And this is not original to me. This is something Roosevelt did. In the 30s, where you had cascading mortgage defaults and foreclosures, they created something called the Homeowners Loan Corporation, where the government refinanced people's mortgages at affordable rates. Now, if you think about it, there's 2 or 3 million mortgages at immediate risk of foreclosure. And most of these are these mafia loans that people got tricked into taking out, where it starts out with a 3 or 4% rate, and then after 2 years it goes through the roof. And a lot of these mortgages were taken out in 2005, 2006, and they are now going through the process in the jargon of resetting, which means the rate goes through the roof. So wouldn't it be better to have a government agency, and I think the one government agency that's competent to do this is the FDIC, say, okay, if you got stuck with one of these mortgages, come on in, and we will trade that in for a 4% mortgage so you can afford to keep your house, so that you don't have this epidemic of foreclosures leading to vacant houses, leading to the whole neighborhood suffering declines in housing values. That's the first thing I do. That's very simple to understand. And if the bondholders get some help, they get it incidentally. They don't get it as the primary beneficiaries. The way Paulson did it, it's bass-ackwards. The bondholders get bailed out, and if the homeowner gets some benefit, that's kind of incidental. I think, secondly, rather than this complicated scheme, I think there are going to be some banks that the government is just going to have to take over and recapitalize and sort out the good assets from the bad assets, and after they're stabilized, sell them back to private enterprise, or maybe keep a couple of seats on the board that the government has to keep them honest. England today, Britain, made the decision that they're nationalizing part of the banking system because it's the only way they can keep the banking system from collapsing. That's how serious this is. So I think it has to be done more directly with more explicit government involvement and not just as a bailout. And I also think the other thing they're going to have to do is, and again, Roosevelt is my role model here, we're going to need a ton of public works spending in the first couple of years. And deficits are the least of our problems. You know, if we can avoid a Great Depression, we can grow our way out of deficits. So, for example, Wisconsin and every other state and a lot of municipalities are having to cut back spending in the teeth of a recession, which only deepens the recession. So the feds ought to be coming in with intergovernmental aid, used to be called revenue sharing, invented by that great Bolshevik Richard Nixon, and prevent cities and states from having to defer public works, having to lay off cops and firemen in the middle of a recession. That's crazy. And that's what the federal government is for. It's there to be the provider of last resort. And in order to keep a financial crash from turning into a depression, you have to keep up purchasing power so that people can continue to afford to go to the store, so that the store doesn't go broke. This is very basic economics. So those are the three things that I would do. And I think Obama is probably, don't mean to do a partisan commercial here, but just based on the two philosophies, I think Obama is probably more likely to pursue something along these lines than McCain is. Sir. Oh, yeah, go ahead.
Well, I wonder how much regulation we can get from these people. My understanding is that between McCain and Obama, they've got $17 million in contributions to their political campaign, as well as having an ethically challenged Congress and Senate in power too. What can we really expect?
You know, I think what has happened, and I have the same criticisms of Congress that you do, but I think what has happened in the last couple of months is a game changer. I think we haven't seen anything like this since 1929. And I think even an ethically challenged Congress is not going to want to see the whole economy go down the drain. Ultimately, the donors don't elect these guys, the people do. And the people have every right to be extremely upset. And I think the people are going to be paying attention. So maybe I'm an optimist. But I do think in this kind of a crisis, things are possible that are not possible in ordinary times. And all of a sudden, everybody is in favor of financial regulation. People who a year ago, like Hank Paulson, wanted to continue deregulation, all of a sudden are born-again regulators. I mean, you have John McCain talking about greed on Wall Street. Amazing. So these are not ordinary times. You had a question, sir. Over here. Thanks.
Yes, you had touched on derivatives. The Wisconsin retirement system invested and lost millions and millions of dollars, and when then they asked this board to define what they had invested in, they could not tell them what they had bought. Now, you've further defined derivatives, and other than this is some sort of Ponzi scheme, does anybody know what they really are? Is there a simple a definition that a PhD, a non-PhD like myself, might better understand what they are and why they basically ruin part of the economy.
Right. Well, again, you take something like a loan to a business that is an actual asset on the books of a bank. A bank examiner can go into that bank and ask one basic question: is the loan paying its interest on time? And if it is, the bank examiner can say, great, that's a performing loan. And if it isn't, the bank examiner can say to the bank, you need to set aside some capital against the risk of that loan going bad. So it's transparent. You can understand it. Now, if somebody from Wall Street comes along and buys that loan and bundles it with 200 other loans and repackages it as a bond, that is a derivative. It's derived from the loan, and it's much less transparent than the loan. You can't figure out what the thing is worth, because what it's worth is a function of a whole package of loans that may or may not go bad. And then if you, on top of that, write a contract against the bond going bad, that's a derivative on top of a derivative. Now, I have a very simple program that I'm basing my candidacy for presidency on, and my slogan is plain vanilla. Plain vanilla. I just wrote an article about this. All this stuff ought to be prohibited. It adds nothing to the efficiency of the real economy. All it adds is risk, and it adds catastrophic risk, because when one of these Ponzi schemes unravels, everybody gets hurt. So my argument is we need to go back to a plain vanilla banking system, meaning you have one kind of institution called a commercial bank that takes in deposits and makes loans, and an examiner can tell very straightforwardly whether that bank is in good shape or bad shape. You have another kind of institution called an investment bank that underwrites stock. And if you have a greater taste for risk, you can buy some of the stock. And the investment bank needs to be examined with the same thoroughness as a commercial bank. End of story, no derivatives. What's interesting, by the way, is that the most successful economy in the world right now has that kind of banking system. The Chinese have a banking system that takes deposits, makes loans. End of story, no derivatives. They're prohibited. So, you know, you sometimes hear financial economists say, well, if you try to prohibit this, the wise guys on Wall Street will just invent a way around it. No. If regulators are vigilant, it's not difficult to say, you may not do that. We don't allow that. If you want to conduct commerce in the United States of America, you may not sell these things. And if you want to sell them overseas and do business in the United States, you may not open up shop here if you do it abroad. It really isn't that hard, even though it's complicated. And they have messed up this thing so thoroughly that untangling it is going to take years and years. And of course, not all that long ago, there was a concept called fiduciary duty, that if you were a state pension fund, you were supposed to keep it simple. And the wise guys got to the pension funds and said, hey, you're making 8%, I can make you 15%. Invest in X or invest in Y. And they never should have done that. A lot of people are going to get hurt. So we're going to have to go back to plain vanilla for a while, maybe forever, because other than making a lot of middlemen rich, I think all this razzle-dazzle does nothing for the economy except to adding risk. You know, the story used to be that derivatives and collateralized debt obligations and all this fancy stuff was great because it spread risk. Well, yeah, it spread risk the way an epidemic spreads diphtheria. And we don't need this stuff.
Since political ideology goes hand in hand with economics,
Yes.
we've had a political ideology that democracy equals free markets, unregulated capitalism. Now, in the 1920s, when it fell apart, most of the world went to fascism
Right.
as a solution, or to Stalinist communism. Are we going to see now people turning to Chinese capitalism with its strictly authoritarian government as the big solution around the world and, outside of the United States? Or?
Well, it's funny. I love to read history, and I'm one of these old-fashioned great man theory of history people. I mean, nowhere is it guaranteed that a depression gives you Roosevelt. It can just as easily give you Hitler. And if that bullet had hit Roosevelt instead of hitting Mayor Cermak, we would have had Cactus Jack Garner as President of the United States instead of Roosevelt, and God help the Republic. So, no, it's not guaranteed that a crisis will produce great leadership, but it's possible. And you do have to worry that when people lose their jobs and their homes and become terrified, you don't know what kind of leader they're going to turn to. So that history has yet to be written, but it puts all the more pressure on the next president to get it right, because the United States of America, even in its current conditions, still has more influence than any other country in the world, any other economy in the world. And the world is looking to our leadership. We caused this mess. These products that have infected the rest of the world were invented in America. We have an obligation to cure the mess that we've created. And if we want people to turn to democracy rather than to authoritarian Chinese quasi-communism, quasi-capitalism, or to other forms of dictatorship, we have to get this right. Yes, ma'am. Go ahead, and the lady here in the fourth row next. Go ahead.
I was wondering if
Good.
you could speak to our war of choice and put that in a context of our economic times.
Well, I was not supportive of the Iraq war. I think we're wasting upwards of $100 billion a year that we could be putting to better use at home. But it's interesting how the war has kind of faded as a paramount issue in the election, because the economy is so much more of a dire threat. I hope one of the ways that we can come up with the money that we need here at home is to wind down the war. Everything that can go wrong in a war went wrong in this war. There's a ton of corruption with the contractors, with the oil companies. We've privatized a lot of the military. That's a subject for another day. So I think the relationship between the economic crisis and the war is rather indirect. They're both products of a not terribly effective administration. The sooner we can end it, the sooner we can spend the money on useful things that we need at home. Yes.
I just have a question about Social Security. Everybody gets money taken out of their checks for it, and I've heard through the grapevine that when I get older and actually need it, that it won't be there for me. I just have a question. Is that true? And if so, where is this money going, and why is this happening?
Right. I can promise you that it will be there for you. One of the great myths is that Social Security is going broke. The balance sheet of Citibank should only be in as good a shape as the balance sheet of Social Security. Let me give you the statistics. The projected 75-year shortfall in the Social Security accounts is 1/3 of 1 year's GDP. That's called a rounding error. Whether or not that is true is within the statistical margin of error. And the Social Security actuary is using very, very conservative assumptions to make these projections. Now, the right wing early in this century went on a crusade to privatize Social Security so that the money would be invested in the stock market instead of being guaranteed by the government. Just imagine what would have happened if all that money had been invested in the stock market and then the stock market crashed. So the claim that Social Security is going broke is propaganda, pure and simple, and it's a very well-run system. One of the problems is that the deficits that have been run up because of the tax cuts in the past 8 years have come out of money that was intended to increase the surpluses in the Social Security accounts. And we're going to have to put that money back. But Social Security checks are government guaranteed in the same way that deposits in banks that have FDIC insurance are government guaranteed. It was charming to see President Bush go on television about 3 months ago, when there was a run on a bank in California, and say, don't worry, it's government guaranteed. I mean, this from the greatest government basher of all time. So I think times have changed, and people are going to be very grateful that Social Security was not privatized, and you don't have to worry about Social Security being there. Yes, ma'am.
First is, you seem to be anticipating, I don't need it. Trust me.
You seem to be anticipating that we may see an era of re-regulation, for lack of a better term.
Yes.
When I look at the size of the institutions that we are currently in the process, financial institutions, of creating, consider, for instance, the current size of the Bank of America.
Mm-hmm.
I could think, when I consider what they may have in reserves, that I'm sure they don't, to guarantee their DAs. Much has been written about the lobbying force, especially the lobbying force in Congress of such corporations. Do you anticipate that a president and Congress we have would be able to withstand their resistance to regulation?
Well, it's a very good question. There are two theories of how to proceed here. One is to break big institutions up into smaller institutions. The other is to have a fairly small number of large institutions and then regulate them very carefully. We have to do one or the other. I think we're going in the direction of consolidation as smaller institutions fail. And I think people who live through this will learn a lesson that you cannot let these institutions run wild, or you, the government, you, the taxpayer, pay a terrible price. And I'm quite confident that the next era will be an era of re-regulation of finance and simplification of finance. There will be battle royals about the details. But I think the stakes are so high. And at the end of the day, and this is my story from the Roosevelt era, if ordinary people get mobilized and start participating in politics again the way they once did, political democracy can fight capitalism to a draw. It can be the counterweight that we need to keep lobbyists from very wealthy institutions and representing very wealthy institutions from hijacking our country. And I think the pendulum is swinging very, very rapidly, and we are heading back towards one of those eras of revitalized democracy and more effective government. Now, I could be wrong. The whole thing could go down the drain and we could get Hitler. But I guess that's too depressing to contemplate. And you could call this the audacity of hope.
Okay, the other
Please.
question, really, and then to bring back entirely. When you were talking about your platform for your presidential campaign,
Yeah.
yes, I've got such stuff myself.
Oh, well, you could be my running mate.
And so I have a question for you. Do you think it would serve any purpose in this country to return, I have my concern about floating currency rates, to the gold standard?
Not the gold standard, because there are problems with the gold standard, but you need to return to a much more regulated system of exchange rates. One of the ways we went to hell in a handbasket was to allow speculation in currencies, which we did not have in the era when rates were fixed. But they were not fixed to a traditional gold standard. It was a kind of a hybrid under the Bretton Woods system. Problem with a pure gold standard is that you hold hostage the supply of money in the world to the supply of gold. And if the world economy is growing faster than the supply of gold, you artificially hold down the ability of the economy to grow. That's why the Bretton Woods system was invented, which was a kind of a hybrid, an elastic system. And I do think we need something more like the Bretton Woods system, because the current system of floating rates just encourages currency speculation. And all that does is enrich a lot of middlemen. And again, a lot of these derivatives that have so destabilized the financial economy are a byproduct of speculation in currencies. But I wouldn't go back to a gold standard. Sir. Oh, I think people are doing pretty well just talking. I know you think you were too young to be called sir, but I meant you.
That's okay. I'd just like to preface with, I'd like to add to your reasons why we were so prosperous after World War II. One of the few prudent foreign policy decisions I think the United States has ever made was the Marshall Plan.
Yes.
Giving dollars to post-Soviet countries, and post-war Western countries, make sure communism doesn't spread.
Right.
They spend money on our products, we'd make them. Also, after World War II, the society was a saving society. People had saved up during the war. No one would spend anything that couldn't go overseas to help fight the war. That boosted the economy as well. Well, today, I think it's true that many Americans are in a lot of credit card debt per se. Mm-hmm. And throwing $700 billion not only at faulty corporations, but to housing markets, these are people that people are also to blame for this, not just greedy mortgage brokers, but people who try to live above their means. A garbage truck driver can't afford a several $100,000 home. All this is sort of piled up, and throwing $700 billion at it's going to be like throwing floaty toys at a sinking ship, because it's artificially propping up what will eventually have to be a recession. With all this debt trying to pay off last year's GDP, it's going to go into a recession. So I think despite any attempts to revitalize the credit crunch, it's not going to work because the private, consumer sector is still in debt as well.
Well, I agree with most of what you said, but I want to take issue with two things. Most of the people who got suckered into taking out subprime mortgages were ordinary people trying to get a foothold in the American dream. They were not people trying to live above their means. They were people taken advantage of. About 20% is the generally accepted figure of people who took out subprime loans did it as speculators, and I don't have much sympathy for them, but I have a lot of sympathy for the other 80%. Now, on the question of the inevitability of a recession, this was the great insight of John Maynard Keynes. Recessions are never inevitable, because if there's unused productive capacity in the economy, there's no excuse for a recession. All you have to do is get purchasing power back into circulation so that people can buy the products that industry has the capacity to make. And there was a guy named Andrew Mellon, who was Herbert Hoover's Secretary of the Treasury, who was infamous for saying, purge the rot from the system, let it bleed. I cannot remember the exact quote, but liquidate assets, have a fire sale. And he was just flat out wrong, because if you just let it bleed, the recession feeds upon itself. People who lose their jobs lose their ability to put food on the table, stop going to the store to make purchases. Other people lose their jobs. Other loans go into default. Banks go bust. And the whole thing goes into a downward spiral. And even though some people were living beyond their means and there was too much credit card debt, and you can point fingers of blame to lots of people. It's not a good solution to let the whole thing just collapse. So even though some people who are undeserving are going to get bailed out, and we could certainly design a much better bailout than the Paulson plan, starting with homeowners, it's not a good idea to just let it collapse. You want to come back at that? Go ahead. Well, he was a deathbed convert.
I'm a retired banker. I ran a bank here in Wausau.
Plain vanilla, I bet.
Vanilla. I retired in '88, and believe me, they're not running them today like I did when I ran it in '88.
Nope.
Period. In addition to that, there's what we have to do is this whole subprime thing turned into the disaster even I couldn't figure out. And one of the things, I ran a charge card department for a bank in Milwaukee, and we were getting a ton of applications in when we came out with the plastic first. And I said, you know, what we're going to have to do is put a credit scoring system in here so that we know what we have in that pile. And by that I mean, if you worked at Allis-Chalmers for 20 years, had a 50% equity in your home, and owned your cars free and clear, you were rated a 1. And from there, it graded up to about a 5. If you drifted into town and married some young lady, had 3 kids, and she got married because she wanted someone to pay the bills, he was rated a 15, or we turned him down. Had they done that in the subprime mortgage fiasco, Paulson and the whole bunch don't have the foggiest how much we got in there. There are some honest people in there, but they'll never sort them out unless they didn't credit score them going in. And then the charge card would work perfectly, because what happened, if there was a guy rated a 15 and he was past due 5 days, we were rapping on his door that afternoon. If he had the job at Allis-Chalmers, as I described first, we'd send him a letter and say, would you like your credit line increased? They knew what they were doing.
Right.
But they don't now.
Well, you can't know what you're doing with derivatives. You're at
Yeah,
so many levels of abstraction away from your customer that you have no idea what these things are worth.
Right, right. They bundle them up. The broker, investment bank takes a big 20% commission, and they peddle off 100 million of, they don't know what's in there. They don't have the foggiest.
Right.
Scary as hell.
Two maybe minor points. I'm more on the prosperity part rather than the finance part. One is that maybe I read more about Eleanor Roosevelt than FDR, but I think she is a big part of what changed him from the ideas going in and the ideas that actually happened. And the other thing, when you talked about the Social Security and the group that were working against them, they also packaged the public schools in that. Same thing, and for very many reasons, that's tied into our prosperity, our people being able to have jobs and carry them out and so on. So I think those two things tie together.
Thank you. I agree. Some folks, other folks who haven't, yes, sir?
I couldn't help but hear you speak twice of the oil shock during the 70s. I remember that very clearly. It was the first time that I know my folks seemed nervous and on edge, and I was in college at the time, and my dad was telling me to make sure my tank is topped off, et cetera, et cetera. And dovetailing it into what you had talked about as a solution, a possible solution in this bailout crisis. And also reading the shock doctrine, which I'm not through with yet, I can't help but think that, and I called my representatives on this, that they moved too quickly, too fast without exploring all the solutions. And I was wondering what your opinion of the timeliness of this and how fast it moves through, and is it irreversible, or is it something that, you know, I can still pursue? I'd love to hear your...
You jump at the Paulson bailout?
The current one that was just passed.
Well, Yeah, that was exactly my view. I mean, Paulson came before Congress over a weekend and scared everybody silly. And he had the bill written on a Monday. The bill was 2.5 pages. It said, give me $700 billion and I will spend it as I see fit. And instead of saying, wait a minute, this whole approach is nuts. We're going to take 2 or 3 weeks. We're going to hold some hearings. We're going to look at alternatives to the whole approach. The Democrats in Congress, I think, got stampeded into thinking that they could take this basic concept and tinker with it. So now he has to report to a committee to oversee what he's doing. And the government can get a very complicated kind of equity share. And they've asked him to be more proactive in refinancing mortgages. And then they threw on some pork. But it's still the basic plan. And I think, I mean, I talked to Barney Frank, who I know fairly well and who I have a lot of respect for, and I said, take 2 or 3 weeks. You know, if things go on for 2 or 3 more weeks, Bernanke will just keep bailing the thing out. The world's not going to change in 3 weeks. More important to get this right than to do it overnight. And he said, they have a gun to our heads. And I said, no, you have a gun to their heads. They're coming to Congress and asking you for $700 billion. You have the leverage over them. But I think the congressional leadership was so afraid that the thing would worsen if they didn't act immediately, that they didn't want it on their conscience. So what happened? They passed a badly flawed bill, and the bottom fell out anyway. I mean, people thought that maybe, even if this was badly flawed, there'd be a week or two when markets would say, hey, $700 billion, things are going to brighten up, and the market would go up. Instead, the market went straight down. So I think the next administration is going to have to do this right. They're going to have to spend even more money, and they're going to have it better targeted, and they're going to have a ton of public works spending as well. And, you know, that could have a lot of real benefits. We could have a modern electric grid in this country. We could have renewable energy in this country. We could have mass transit. We could rebuild public systems. There's a $1.6 trillion shortfall in basic infrastructure, according to the American Society of Civil Engineers. And all of these are middle-class jobs that stay at home. So out of this crisis could perhaps come something good. And the other encouraging thing is that when the Great Depression happened, when the stock market crash of October 1929 happened, Hoover had been president for 6 months. We had to wait 3.5 years for the next administration to come in with different policies. Now we only have to wait 3.5 months. So maybe if the next administration acts quickly and creatively, you will have a financial crash that is contained and that doesn't spill over into a second Great Depression. Sir. Well, I don't speculate. Well, I think even McCain, who I'm no great fan of, and let's not even talk about Palin, but even McCain, I think, would have to be very different from Bush, would have to be a much more assertive presence, or the economy just falls in on him. And it was encouraging to hear him say in the debate that we need a much more aggressive mortgage write-down program where you are writing down the principal amount of the mortgage as well as interest rate relief. So, you know, if Republicans are fighting with Democrats to see who can do the better imitation of FDR, that's good.
Good evening. I want to first thank you for coming here tonight and
Sure.
and giving a topic like this exposure to North Central Wisconsin. I'm also an economics major, although I never went into that profession. I have always been interested in that, and I was able to tell somebody the other day I was going to see one of my favorite economists, which that person also didn't think they ever heard before, in a sentence, a favorite economist. So I just wanted to let you know that. You briefly mentioned earlier progressive taxation as being a component of the growth in the post-World War II, post-Depression era, and I agree with that. You've also written that private equity firms, purchasers who are able to use tax-deductible maneuvers for loans that they take out to purchase other companies is a practice that you think should be changed. Can you list some other changes in the tax code that you think would significantly benefit our current situation and make things maybe return to that post-World War II growth era?
Well, yeah. I mean, payroll taxes are very hard on workers. They're hard on job creation. I would lift the cap so that people who make over $100,000 pay at the same rate that everybody else does, and then I'd put an exemption in at the bottom so that the first $20,000, say, of income is exempt from payroll taxes. One of the scandals of the past decade is the inversion of who gets audited. The IRS, and there's a book by a New York Times writer named David K. Johnston on this, you've got these tax shelters that are so complicated that even the IRS has trouble figuring out whether they're legal or illegal, and a lot of them are illegal. A lot of them involve offshore maneuvers, so it's hard to trace the money. And in the last administration, they took auditors and they took them off the case of auditing these partnerships that are tax dodges used only by very wealthy people, and put them onto the trail of people using the earned income tax credit, the working poor. And I was at a conference about 2 years ago of former commissioners of IRS, and the general consensus was that there's about $300 billion of evaded taxes by the wealthiest 1% of the population that are left on the table that could be collected without raising anybody's rates, without affecting the bottom 99%. So I think reversing the priorities of tax enforcement, so you go where the money is. You don't go after some poor SOB who's making minimum wage and trying to put bread on the table and taking advantage of the earned income tax credit that Congress duly passed to put a little bit more money in the pockets of working people with families. I think tax benefits for companies that move jobs offshore, that's crazy. And just restoring basic progressivity to the tax code so that people making $250,000 and up are paying at a higher rate than the middle class would be a good thing to do. I think restoring the estate tax on estates over $1 million would be a good thing to do. I mean, there are lots of ways to get revenue that the country needs and also reduce the tax burden on working people. So, in announcing my candidacy, that would be my tax plan. Yeah.
Back to the events of the last week. Isn't there a mass psychology within the financial markets as to where the bottom is, and that it was necessary to restore confidence to the market? That's how the Paulson plan was sold, is that it's necessary to act promptly, not within 2 or 3 weeks. So what do you make of that argument? Was it necessary for the government to get involved in a period of days in order to prevent a form of market hysteria?
Well, the problem is that everything they predicted, if Congress failed to pass the plan, has happened even though Congress did pass the plan. So I guess what I was arguing at the time and what I'm still arguing is it is necessary and was necessary and will be necessary to pass a rescue plan, but not this rescue plan, a much bolder, more direct rescue plan that is bottom up instead of top down, that has more direct government involvement in the recapitalization of banks that gives government an equity stake, and acting quickly to pass a bad plan, it turns out, was not a good idea because markets continued collapsing. So that's what happens when you get stampeded into passing the wrong plan. Last question. Yes.
Do we need a reform in corporate governance? It seems to me we give charters to businesses to organize, and then they lobby back and don't necessarily represent the interests of the community. The industry, they're somewhat disconnected. They work for the profit of the stockholders and for the board and for the chairman, and without reform of that, I think we're still going to have trouble. Small business, I ran small business and we competed, but we were directly involved in the business that we ran. It seems to me these boards are often so disconnected that the meaning of ownership, it is a quasi-public ownership, and yet it doesn't serve the public interest very well.
Yeah, I think, of course, corporate governance reform is a whole other subject. There was a proposal from the progressive era that I think should be revived on federal chartering of large corporations. I mean, what you had in the 1890s was a classic race to the bottom where Delaware and New Jersey and other states competed to see who could have the most lax standards, and corporations flocked to Delaware, which had the weakest corporate chartering laws in terms of public interest. So this idea would be if you're a corporation of above a certain size, you have to get a charter from the federal government, and certain things go with that charter in terms of what the corporate governance structure has to be, rights of minority shareholders, rights of outside directors, audit processes, rights of people who organize unions, worker members on the board, just a whole range of things to make corporations more accountable. And you know, again, going back to the 30s, this was a whole age of reforms of many kinds, and I think that's what we're going to need in the next era, and maybe that's a pretty good note to end on. So thank you all for coming. A lot of food for thought here.